I would like to welcome everybody back on the second part. This is the part where Birger Schäfermeier will talk about the trading process, and he will introduce actually three strategies. Basically, this part will be like 1 hour, 15 minutes, something like that. And then we will have a break at 2:30 till 3 o'clock, and from 3 o'clock we will go until everybody gets tired, especially Birger. So let me give the mic to Birger to continue with trading process.
So, thank you. Wow. So all of you back, so the first part couldn't be too worse, huh? So looks like you enjoyed that. Me too. So second part, now it's getting a little bit more practical. I know the trading business, you can talk about so many things, psychology, strategies, analyzing. So we have to focus on a few things today, and for me, very important, what I already mentioned in the first part, is the process. Because my philosophy is, if you have a good process, you will get good results. It's very, very easy. Yeah? And a good process is defined by a process which is so easy to follow that it costs you not much energy. Because all the things in life which cost you much energy, so if you want to do some things and it costs you lots of energy, it's the odds that somebody sticks to this process are small, yeah, because it's exhausting, maybe, the process, and they think, oh, I don't want to do this anymore. So if you want to lose weight and you do some extreme things, yeah, usually people will stop to do this and say, no, it's too complicated. Then better I stay with 10 kilos more or whatever. So if you find something which you don't need much effort to do, then it's very easy to follow this. And that's what I try to do with my trading process. In fact, you already know this process, and it looks complicated, but it isn't complicated, and it takes not much time. So for example, if I'm doing my analysis, I'm analyzing in the morning 4 up to 6 markets, and I usually don't need more than 15 minutes to do the complete analyzing. Yeah? Sure, I'm a day trader, so the situation will not change from one day to the next day completely. I could use my analyze from the day before, but you know, I'm doing the same things in the same moment, in the same way, and that costs you not much energy. If you every time have to invent a new process and a new idea or so, and then it's hard to do a good analyze in the trading. But I do the same thing. So first of all, I'm looking for the advantage, and when I'm looking for the advantage, I'm just have a very, very simple thing. I'm just looking at highs and lows. So it's a very common thing. In an old theory, it's called Dow Theory. So if you have higher highs, higher lows, it's an uptrend, lower lows, lower highs, it's a downtrend. It's really very, very simple. I don't want to make it complicated, because the complicated things usually don't work. So it's not so hard to figure out. If we can maybe open one charting tool. So, for example, maybe we start here with, we choose some extreme. So, okay, just one thing. British pound, there is it. So, and so I don't have a mouse here, so it's a little bit more difficult for me. Usually it's very easy to do all the things if you have a mouse, but without computer mouse, it's not so easy like I want. Maybe it takes this week. So, very easy thing. So, just by watching, and I don't need this moving average. It's inside the chart, but I don't need this, therefore. It's just because this computer is just a presentation laptop. So on this computer, it's just some demo platforms and demo, even my analyzing tool, my trading diary is not complete on that there because I'm just using this for the presentation. But the only thing what I want to know is, this is a low on the weekly, this is a high on the weekly, this is a low on the weekly, this is a high on the weekly, and new low. So this trend is on weekly down, but this was also on the daily down. So you could see this here on the daily chart. So low, high, low, high, low, high, low, high. So it's telling you a clear speech or a clear signal what this market wants to do. This British pound against US dollar. And it's not down since yesterday, it's down since 2014. And there never was a period where we had on higher time frames, higher highs and higher lows. Yeah? The best, the bullish situation was here before the Brexit, when the market makes high, low, high, but this low was very close to that. That's not good. And here, that was not significant. This was 2 days, or even 1 day, 24 hours higher before the decision, and after that, the market came down. So we have, since August 2014, I never have to change my long-term analysis on that. The market is telling me it wants to go down, it goes down, yeah, and that's what's happening in this market. This doesn't mean that it's falling all day long, yeah, but the odds that it's going down are higher than the odds that it's going up. And on a 60-minute time frame, so on a 60-minute time frame, yeah, you see here, that's the significant move. Now, maybe that's a correction move. We will talk about this correction move a little bit later. But you could see most of the time, highs and lows are falling. And this huge drop here, maybe some of you are trading British pound against US dollar. There was a story that this was a fat finger trade. So somebody pushed a wrong order in the market, 4,000 future contracts in the night session. So that's a market drop. But if that's the truth, so first of all, why not the market is directly recovering, still under this price? And second, I'm not wondering, or no, it's not a question why it's coming down, because the trend was down. So what I'm doing is, and that's what I do, for example, if we have British pound, so daily chart is down. So then I'm checking maybe 60-minute chart. And so I'm looking back on 60-minute chart for, usually as a day trader, for 14 days. So, so here, mid of October, you could see here that's not really going down anymore. It's not really going up. Maybe it's slightly up, but most of all, it's not significant, so I would say sideways. And the 15-minute short time frame, this looks in the moment high, low, high, low, high, low, high. So this may be going up. So, and it's going straight going up. And the advantage of such situation, because it's a very mixed situation, is, okay, in the moment, still the bigger trends are down, but we are in neutral. Yeah? So this is, for me, more or less a situation where I say, okay, the advantage, there is no advantage. So it's not the market which I really like to trade. This would be different. This has been different when in beginning of October, yeah, the 60-minute were down as well. But now in the moment, it's more or less no advantage. If I have no advantage, the aggressive trading, so here's this equity, it's just a demo, so it's usually it tracks your performance automatically. So we put this here neutral, so this means, okay, aggressiveness, very low, maybe no trades. So, and I can do this for all markets. So, for example, if we switch to another market, we maybe we go to maybe DAX. No, DAX is not here. Maybe we Euro US dollar. We change, take that. So you could see 2014, and after that the market on the daily time frame is not moving anymore. It's not significant higher lows and lower lows. It's some higher highs, some lower lows, and higher highs. So on a daily base, Euro, US dollar, so it's sideways. On a 60-minute time frame, and that's for me more important as a day trader. Just 1 second. 60-minute time frame. On a 60-minute time frame, since October, we see up, down, up, down, up. So on 60-minute, it's going a little bit up. But if we consider the bigger picture here, this moves. It is up, but it's maybe not straight up. It's more that. On 15 minutes, 15 minutes. This is small highs and lows. They were up, but already the market makes here new lows. It's now below this low. It's not really down. Maybe it starts here to getting down, but it's sideways. So it's slightly long, but not only slightly, and maybe it's close to neutral. Perfect date to doing a seminar. Yeah, I'm not missing much, I think. What I'm doing next in the trading process, so I'm looking for this advantage, and this is not changing all day long. I'm checking market conditions. So highs and lows. Are these highs and lows overlapping or not overlapping, straight or not? We have several market conditions, and I will maybe show you the market conditions here on this slide. For me, there are 9 possibilities of market conditions. The market could go up, choppy, trendy, or with momentum. So the difference between choppy and trendy is that we have overlapping highs and lows. In the choppy market condition, in the trendy market conditions, we don't have. And momentum means we could have overlapping highs and lows, but we have one huge move, one bar, which is bigger than all the others. That's a special case. So usually we have just choppy or trendy market conditions up, same on the downside. And if the market is going sideways, the market could go choppy sideways. Sometimes in a big range, we have some trends within a range, and sometimes we have some momentum within a range. These are all special cases. So usually, most of the time, we have these cases here. So that's what I'm doing with my software and analyzing that. And after that, I have several tools, and I want to introduce these tools. What I'm checking, these are not all my tools, but some very important tools. So I'm checking seasonality, sentiment, volatility, the Fed Watch tool, correlations between markets, and liquidity. But I do this all day the same way. So it's not that one day I'm just looking at the seasonality, next day I'm just looking at the Fed Watch tool. I'm just watching all these tools every day. And so I could make sure, because I'm checking the environment under this special circumstances every time in the same way, that I realize maybe if something significant will happen or not. So for example, it's a very easy thing. So we can do this maybe here for DAX. I could not explain to you all the tools today. I just want to show you. For example, sentiment. So that's the 1-year sentiment from the EURAX. Yeah, I'm checking the DAX, and you could see sentiment is slightly positive, but usually sentiment tells you just where the market is, not where it wants to go. But if sentiments have some extremes, like last year, January, extreme means usually the market is doing the opposite than the sentiment is doing. Yeah? So that's one thing for the sentiment. For the seasonals, I'm checking what should I expect from 30-year statistics within the next few months. Usually in DAX you could expect from October to December that the market is going up, usually. But now, this year a special cycle. We have this election cycle, so it's a different one. And you could see here, so DAX in November is not performing good, yeah, during election years. So, to repeat myself, it is not a must that the market fall, but statistics says it's more likely that a November market comes down, not huge down, but down, than it goes up on DAX, yeah, in election years. That's what the statistic from 1956 to 2008 is saying. Okay? And so that's, for example, the seasonality tool, the sentiment tool. I'm checking volatility. I come back later to the volatility. And I check as well, because for traders, it's important to know what the central banks in the world are doing, because there is a saying, and this is most of the time true, never fight the Fed. So never trade against the Fed. So if the Fed, for example, wants to raise interest rates, it's not a good idea to bet against that. And so it's very interesting to check what are the likelihoods, that the Fed will change interest rate. And I have a really nice tool here called the Fed Watch tool. And with this tool, you can check the odds that the Fed will change interest rates. The next date is 14th of December. And you see there the probability, current probability, that's the probability from yesterday. That's the Fed fund targets now. And this would be an increase up to interest rate hike. So you could see the probability for interest rate hike is 71.5%. And you have to know that never in history, ever, the Fed raised the interest rate as long as this probability wasn't above 60%. So the whole year I was checking these parameters. And for all dates, for all Fed sessions, we were below 60%. But now it's the first time, the last 2 weeks, it started to going up, up, up. The first time that this Fed Watch tool is telling the Fed, the likelihood that the Fed will move, that they will hike the interest rate in December is 71%. Okay? So, and knowing this is very important for a trader, because you have to know if something is priced in the market, or if the market starts to price in some moves in, and you have to understand the fundamentals. And usually fundamentals mean if they raise interest rate, that's not good for euro, that's good for US dollar. It's not good for S&P, it's not good for DAX, it's not good for bonds if they do that. And it is, if we check, where's the trading process, just one sec. So if we had here this process, and I had here the tools are only one part of my analysis. It's important to check the advantage, that's highs and lows. Then you check the market conditions. And the tools are only a help to decide, maybe to give this market conditions a little bit more value or less value. But so that's what I'm doing when I'm checking the market, in short. Yeah? But I could do this all day very, very fast. One thing I want to show you is liquidity, because liquidity is very important for markets. And here, what you could see on that chart is how liquidity works in markets. That's S&P. And S&P, that's the financial crisis 2008, and the market drops, drops, drops. And here on that point, November 2008, the Fed starts with this program quantitative easing 1. And 600 billions in bond buying, this was a 600 billion bond buying program. And you see, after the start of the program, the market moved up until the end of the program. When the program stops, the market drops. So Fed decided here to enter a new program. That the market starts to move higher before is because market was anticipating that Fed will release a new program. So next program starts here, it ends here, the market drops. So you see, this extra liquidity is important to move the market up. If it stops, the market drops. After that, there was some called some thing from the Fed called Operation Twist. It's very similar to the QE1 and QE2 program, but it's spending liquidity, and you see the market is going up. When the program stopped, the market drops a little bit, but after that, and that was 2012, the Fed decided for a new program, and this program, maybe you remember, called QE Infinity. So they decided to raise, to buying bonds, not to raise, to buying bonds. Sorry, one sec. They decided to buying bonds here in 2012 as long as it's needed. And so you see S&P is moving up, 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 up. And here, 2015, they stopped the program. And since that, you can see no significant move up anymore. Yeah? And that's important if you trade index markets. You know, they stopped here the program. Here was the first rate hike. Market drops after the rate hike. And now we are just 20 days away, 20 trading days away from the next rate hike. So guess what will happening? Yeah? So the odds are very high that the market goes further down, not up. Yeah? Because Fed is withdrawing liquidity, and that's not what the market really likes. But it's not a forecast, and you have to understand, I'm just telling you odds. Yeah? So, and if I see now, and if I'm checking now highs and lows, 60-minute, for example, we see low, high, deeper low, high, deeper low. So now, after a long period where the market was just moving sideways, we see now deeper lows and deeper highs on 60-minute and even on 15 minutes. So the last few days, the market starts to establish a trend. And yeah, that's what I'm doing when I'm start this analyze. So I'm going through all the markets I'm trading. I'm not trading all the markets here, but I'm going through that, define the trends, checking with the tools, and then I decide, okay, is there an advantage or not? And then which strategy I want to choose. And the strategy depends from several things. So now this is the Hungarian version. I try to strategy. Okay, to show you something. Okay, these are all my strategies. Yeah, lots of strategies. I just choose one. Each strategy has some parameters. For example, the breakout open range. I'm only doing breakout open range if my aggressiveness is above this level. So from 25 to 100. Below 25, I don't do breakout open range. I only do breakout open range if the advantage is here in that level, minus 100 up to 33 or plus 33 up to 100. Not in that level, and only if my account is in the green zone. I will show you what that means. Going back to that. So, for example, if we, no, maybe we go to some market we already analyzed, but okay, I didn't save that. Here is it. Okay. So, maybe I decide here aggressiveness 0. So you see the breakout open range is red, saying me, okay, under these circumstances, with this environment, we have a trend down, but for some reasons I decided not to trade so aggressive. Maybe my tools tell me don't do that because the trading tools said that market conditions are not good. Then I shouldn't do the breakout open range. If I change here, level of aggressiveness, breakout open range is now green, should be green. Now it's green. Yeah? Same if, for example, here, sideways, now breakout open range is red because I only do this strategy when the market is in this area, as the advantage is here or here, not in this gray area. So this tool helps me when I choose the strategies. Which strategy is right for which situation? It's a very, very easy, process. Just one sec. Okay. So I'm doing my analyzing, then I choose the right strategy. My trade tracer helps me choosing the right strategy, and then I plan the trade. And if I do my trading plan, it's very detailed. So it's not only where to enter, where to exit, what's my target, what kind of trading stops I'm using, what I'm doing before news, when I will pull my limits. So for example, if maybe I have some orders in, when to pull these orders. Do I want to stay overnight or not? There are lots of questions answered in my entry plan. And with my students, I do the following exercise. Usually in my courses, I ask them, make your trading plan and then hand out your trading plan to the guy sitting next to you. And if he understands what he should do, then the trading plan is good. Is there still some questions open? Oh, what should I do? Today are the Fed. Should I cancel everything or stay? Yeah? You have to make up your mind before, because in the moment when the market is moving, everything will be stressful, your focus is so small, and you will not making good decisions. But if you make a good trading plan early in the morning, and I do all the things here early in the morning, then I know what to do right in the morning, and then trading is a very easy job. Then it's easy because I analyze the market, I figured out the advantage, I choose the right strategy, and I have a detailed plan. And the only thing what I have to do is to follow my plan, and that's the trade management. And so trading cost me not the whole day time. I could do my trading, I analyze from 7 to 8. And then later the day, I just manage my trading plan. So yeah, I pull some limits, I maybe change some limits in the trade management plan. Yeah, I will close end of day my positions or when the market reached my target, but I don't have to make permanently new decisions. And that helps me that my trading is not very stressful. And it helps me to repeat my trading. So when I have success, that I could repeat this success. Because if you maybe wake up in the morning, you don't know what to do, then open your computer, see, oh, DAX is going up, I buy, and you buy. And then you make maybe some $100. So next day, you couldn't repeat that. Yeah? You didn't know why you bought. Yeah? It was just luck that the market went in your direction. And if you could repeat your pattern, there are two things. First of all, you could repeat your success, and even if you don't have success, you could change something. You know, okay, in the past I did it that way, and now if I turn this, maybe this will help to improve. You know where to change things. If you do one day this way, next day that way, you never know what brings you closer to your target or further away. So you need to be very structured in the trading, and that's what I try. You know, on my philosophy, the market is chaos. It's a big chaos over there. And if in your mind is chaos as well, this bit will not go. Yeah? So you have to be very structured, and then you could deal with the chaos in the market. So, and then at the end of the day, I do my checkup routine, and one checkup said, did I follow my trading process? Is everything right? Trading journal, I keep my trading journal, and all this stuff I'm doing there. So it's very easy, simple process. Sure, today I could only introduce this process to you in my courses. I teach you that and all the steps and checklists for each step. But today it's just that you have an impression how trading works. What I want to do now is, when we look at the process here, now we will talk about one strategy and one special market condition. The strategy depends on the market condition. So we're looking now for a special market condition, and then we go to a special strategy. And I have three strategies at all for you. 2 volatility-based strategies. This helps you to identify trendy markets. So this is more or less for trend following. And 1 triangle strategy to trade corrections. So here you can trade corrections. This strategy, the triangle strategy, you could use long-term, short-term, intraday, whatever. The ATR and VIX strategy, this is more or less for swing traders, for people who don't have time to follow the market minute by minute or day by day. But even if you have only once a week time to check the markets, these strategies are good. So I tried to mix the strategies so that for all of you, I know lots of you have a job or are busy, you couldn't follow the market the whole day. So I choose one strategy for those, and for the other, maybe who wants to trade corrections, another strategy. So the first strategy is a volatility-based strategy, and I have one important observation with volatility. Yeah? You know the saying, maybe, if there is smoke, there must be fire. Yeah? And the same is with volatility in the markets. So if you see some significant move, and significant move means volatility. Volatility means how much is the market moving? Is this a big move or a small move? If you have big moves, volatility is high. If you have small moves, volatility is low. And imagine a time where all the time you have small moves, small moves, small moves, and suddenly a big move. There must be something behind that move. And this significance of this big move tells you something is going on in this market, and you should check what it is, and maybe it's an idea what to do. And so I have 2 strategies based on volatility. They are easy to follow and strong performance. So these are the vola strategies, and that's what I want to introduce you. First of all, there are 2 ways to measure volatility. The general one is the so-called average true range, so ATR. If you use MetaTrader 4, you have this indicator on your platform integrated. If you use other charting tools, it is in this charting tool a general tool. And it's measuring the existing volatility. And it's by a very easy way. It measures the average move from each day. Yeah, including, and that's important, including gaps. So, for example, you have one candle or bar, it doesn't matter, you have a high and you have a low, and that's the span of the bar. And from here to here, that's the average move from that day. So high minus low, and in this case it's 15. On the next days, maybe it's a smaller move, and it doesn't matter what shape this candle has, high minus low, so 15 ticks, 6 ticks, and if you have the ATR, that's the average true range. So that's the true range of that day, the true range of that day. If you want to make an average, it depends how much days you're looking back. Usually what I'm doing is I'm looking back the last 14 trading days. So the ATR 14 trading days back. If we look just 2 trading days back, here we have 15 plus 6, 21 divided by 2 days, 11.5. So the average move of those both days is 11.5. And if you want to look 14 days back, we have to know what the candles before was the average. You don't have to count this by hand. You can use your computer. It's a general indicator in your computer. So that's the average true range. The other possibility to measure the volatility is something it's called the VIX. The VIX is not in your platform, but you can check this on the website of the CBOE, Chicago Board of Trade, CBOT. And this measures the implied volatility. What does it mean? You know, in the stock markets, there are different products, or in the trading markets. So you have stocks, for example, you have CFDs, you have futures, and one product is called options. There are two ways. You have call options, betting on higher prices, and put options, betting on lower prices. And the price of an option is very difficult to calculate. And that's the reason why I don't recommend for beginners to trade with options. It's a very complicated instrument. It looks easy, but it's very complicated. CFDs are much easier. So for example, if you have an option, you don't have only to know where the market is going, you must also know the volatility, the interest rate, the time until the market will reach that target. And so an option has time value, volatility value, interest rate value. So there are many parts which build the price for an option. But one part which builds the price for an option is the implied volatility. That's, to say it in an easy word, the price people are willing to pay for that option. So, if people think that the volatility will increase, they will pay a higher price for that option. If people think that the volatility comes down, they will pay less for that option, to make it simple. Yeah? So just to make it simple, if people think volatility will rise, they pay higher prices. And this means that the implied volatility goes up. And this could be a sign. And that's the implied volatility is measured by the VIX. I will show you the chart of the VIX from the past years. So this is from 86 up to 2012 or something like that. One chart, the green one is the S&P. The blue one is the price of the VIX. And you see volatility goes up, comes down, goes up. And every time when there is a crisis ahead, crash 87, Gulf War 1 and 2, Asian crisis, Russia crisis, September 11th, 9/11, Lehman crisis, flash crash. Every time the volatility goes up, 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 up. And usually that's the peak when the volatility is up, and on certain levels, like here, you could see that that's the peak of the crisis, yeah, usually. So if everybody is fearful, the show is at the end, yeah. So for a trader, you don't want to sell short if the VIX is high, yeah, because you know everybody is already expecting that the market is going further, and if everybody expects that, yeah, you could not make any money more. So for a trader, if you see the VIX on very high levels, so this is maybe above 40, yeah, be careful with short selling, yeah. Usually the market will turn. That's the first rule with the VIX. But there is a better, and that's the system what I'm using with the system. The VIX tells you a lot of time that the market will drop before the market drops. And that's concept. You could see sometimes that even here, 2008, there was this market drops, but you could see here before it starts coming from a very low level, 2007, and going up and going higher, 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 before the market really drops in 2008. And here's the flash crash. The market also went up higher. And that's a very easy system with the VIX, and I want to introduce that. Just one sec. And it is, you have to calculate the VIX. So you have just to know the closing prices of the VIX. Yeah? And then you can use an Excel sheet and calculate. It's a very easy formula with Excel. The second standard derivation from the mean, from the average. Yeah? And if the market is moving more than the second standard derivation from the mean, that's a sell signal. It's a long-term sell signal. And I'm looking here for the chart. I think it's lost in my presentation, but maybe let me double check. It's not this one I'm looking for. Okay, I can tell you if we go to the S&P, we can do this here. So we go to the VIX. Here's the VIX daily. So already in September, 9th of September, we saw this move in the VIX. And that move already shows the sell signal. So that was the first sell signal. Before that, on that day, here in August, on that day, it's for 26th of August, that day, 26th of August, this was another sell signal where the VIX moved more than 2 times of its standard derivation up. And so remember now 26th of August and 9th of September, and now we switch back to the S&P. That's the daily chart. So 26th of September, that was that day. Here was the first sell signal of the VIX, second sell signal of the VIX. Now the market is here. So the market warns you 2 times, yeah, here and here, that it wants to go down with that easy strategy. Yeah? The only thing what you have to know is closing price of VIX, average of the closing prices from the last 20 days, and then you can check with Excel if the market is moving more than 2 standard derivations away from the VIX. Yeah? It's a very easy formula. And this instrument is very good for timing. It does not say that says that the market immediately go down, like here or even here, but it's a sell signal. So if you have the sell signal, you should be warned that maybe some bigger moves are ahead, because first the VIX goes up, then the market comes down, and later on, when the market really accelerates down, the VIX spikes. So the VIX is a good way to figure out sometimes when to sell. If you don't have, or if you don't want to calculate with Excel, and if you don't want to if you don't know what standard derivation is and so, then you could use the average true range, which is much simpler the system. So what I'm doing is, in the average true range, I have a system where I'm looking for days where we're moving more than the usual average true range. So first of all, you can check with your system what is the average true range. For example, let's go maybe here on that day. In the beginning of September, the average true range was in the S&P 14.55. This means that on average, the market is moving about 15 points each day. Yeah, that's the span of the day, normal. If the market is now moving more than 2 times of this 15 points, then there is some, you know, where some smoke is some fire. This is a sign that there's some smoke, maybe something is ahead. So we see here 14 days, and now on that day here, the market dropped, huge drop. On that day, I could remember this was a Friday, the market dropped from 2160, it's almost 70 down to 13, so a 60-point drop. 60-point drop within 1 day. The average true range was 15 points, so 4 times of the average true range drop. And this was a sign that maybe this uptrend is broken and that the market now will come down. And if you have this multiple RTR setup, this strategy, it's very easy. You wait for a day where the market moves more than 2 times of the average true range. That's why I'm counting the average true range all day here, average true range in my analyzed sheet. Yeah? There, every day I'm looking here, okay, in this market, maybe 64 pips, whatever. Yeah? So I realize if we have a big average true range move, something like that, then usually a further drop will take place. You have now to keep in mind with this multiple RTR strategy, most of the time, not every time, but most of the time, 90% odds that after this move, we see a distribution time. So where the market tries to come back, but never goes above this day, okay? That's the moving day, the average true range day, the expansion day. Then we have a distribution time, and then this distribution will be followed by further drop, okay? So market comes down further. The strategy is now, if you see something like that, some strong move, down or up, 2 times more than the average true range, then you could follow the signal that you could wait for a retracement within this distribution, and then you sell and go for further movement down, put your stop on that. So, real example, S&P, just one sec. Where is my, where down? It hides away. So this is another, but that's not what I want. His signal. Okay. It's just one sec. Yeah, the blue, I see the blue one, but my mouse, okay. That. So, okay. So here we are. Sorry for that. So, here was a drop. Distribution time, you could sell anywhere in this. This depends a little bit from your market experience. Yeah, if you sell directly, wait for a bigger retracement, but you should sell here. And then you see now the market continues that move. This strategy is not telling you how deep this market will fall. Yeah? It's not necessary that you know that. The only thing what it's saying you that it's more likely after this move that the market will drop, like then it will go up to new highs. Remember, as a trader, we only think in probabilities. We never know for sure what will happen, but we have probabilities. There will be some days where this strategy will not work, like after this Brexit, for example. This Brexit day was as well an RTR expansion day. But the market dropped only on the next day and then recovered above this candle, so euro stopped out here, and then the market moved higher. This could happen, but you know, we're just working with statistics. And statistics means, for example, that's for, I think for DAX. From 2000 to 2015, we had only 69 signals, but the hit rate is 82% that we get, that the market made a further drop or went up after this extension day. So this signal is not so frequently, but if it takes place, the odds are very high that the market will go in that direction. So I will explain in detail what is necessary. First of all, the average true range day, it must be an outside day. What does mean outside day? What does it mean? You have here, for example, in the euro US dollar, one candle. This candle is outside from the day before. Here you have as well one candle, but this is inside of the day before. And it must be an outside day. So we don't want days within a range where we have this momentum or this average true range expansion. Second, the close must be outside as well. So the market should not recover on the same day. It should be close lower. And the retracement of the move should be on the same day. So if the market retraces the same day, not more than 50% on the same day. The next day it could retrace more, but maximum retracement 50%. That are the conditions for this setup. And I will show you here this slide. So we have, for example, here the average true range expansion, multiple ATR candle. This part from here to here is outside. This part from here to here is inside in the candle before, but the bigger part of the candle is outside. That's important. Yeah? The bigger part of the candle must be outside. That's the fact here. Okay? Then the maximum retracement from the low to the close is very small on that day, and we never retraced here to that level also. And the retracement on the next day was just here to that level. But that's not so important because the next days are the distribution period, and here somewhere you want to sell, usually. So that's the examples. And now we could check on euro US dollar, maybe. So, can maybe one sec. So maybe I use the other chart because it's so difficult with my mouse, and I don't have. I use the print screen. That's the easiest way. So, for example, euro US dollar. This year, 2016, or last year. So you could see here on that day, the market was moving more than 2 times of the average true range. That's the average true range. More than 2 times. Outside day, no retracement, nice signal. The only problem with this signal was there was no distribution time period, so you have to sell immediately on the next day. That's maybe a problem because if you wait for a retracement, you will never see that. So maybe this signal was good but hard to catch. Then in December last year, we saw from here to here, this was a 600 pips move up, so more than 2 times of the average true range. And the signal, here is the distribution period you could buy, and you see that the market is moving further on, up. And again here, you see up move, yeah, outside, most of the time, small retracement, moving up. So this strategy is good for currency markets, for commodities, for index markets. Usually it works very well in most of the markets I'm trading. Yeah? And I don't want to bother you with my statistics, and so it's just that you see the signal. It's not just by feeling also. I had long-term statistics on that to figure out will this signal work or not. And it's really a nice way to identify some trends. You could see this trend, this trend, this trend. So it's a really nice way. The only thing is that you get the signal maybe within one market 2 or 3 times maximum in a year. So you have to be patient. But you remember, we talked about trading mindset, and you have to remember what's your target. If your target is entertainment in the trading business, you could be entertained all day long by the market, and it costs you lots of money, lots of commission, lots of spreads. If your target is to become a good trader and make money, then maybe it makes sense to wait until you get the signal, then you do your trading and make money. Yeah? But it depends that what you want. And most of the people get that in life what they want. Yeah? But sometimes they don't know what they want with their conscious, but unconsciously they want some entertainment, exercisement, whatever. Yeah? Then you get this in the market. But if you want to make some money, then wait for the signals. You see in 2015, 3 signals or so. It's not much, but it's usual for that strategy. Same with the average to range, with the VIX strategy. Usually you get not too much signals with that strategy. So these are some long-term signals you could use for trading. And for the swing trading, it makes no sense in day trading, because if you enter here, you don't want to enter here, out here. You want that this move will be continued. At least one time average, one ATR move more. So if the ATR is, for example, 100 pips, another 100 pips. So that's what you want, usually. So in the next part, I want to show you some strategies for triangles. And triangles are consolidation patterns. And it's not easy to trade them. It's much easier to identify them. But even if you identify them, you're not in a hurry. So usually what you should do is you should wait until you clearly could identify the triangle, then you wait for the breakout, and after the breakout you will trade this. 65% of the time the market is moving just sideways in consolidation patterns, especially this year in election years. It's more than 65%. And the problem of triangles is on the basis of their shape and structure, triangles are not easy to trade until they are fully developed. So that please keep in mind. The start of the formation on the triangle is always the widest point. And as the market continues to trade in a sideways pattern, the range of the trading narrows and narrows, and the point of the trading is formed. The point of the triangle is formed. So I will show you what that means. So typically, you have a move down, and then the market goes up. That's the widest point. And then all swings getting smaller, 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 and sooner or later the market breaks out. And when we talk about triangles, it's very important that you understand there are different kinds of triangles. So they have different shapes, symmetric triangles, ascending triangles, descending triangles, expanding triangles, so different shapes. But altogether each triangle contains 5 moves. 1 move, second, third, fourth, 5. This move is already the move out of the triangle. So we labeled these moves A, B, C, D, E. It's not necessary to label them, but it's easier if I do a presentation and if we talk about triangles that you know which point I mean in that triangle. So in your trading at home, in front of your screen, you don't have to label them. We have 2 lines. We have this AC line, which connects point A and C, and we have the BD line, which connects the points B and D. It's important to understand this BD line must not connect this point, the start of A. It's not necessary. In this example, it is the case, but it's not necessary. So AC line and BD line. These points are connected, and the AC and BC line converge, and finally they meet, and so this forms a triangle. The E is always the last move before the market breaks the BC line, and that's important. In trading, we never try to trade the breakout of this AC line. Never. Because the correct AC line we know most of the time only afterwards. We concentrate on this BD line. And we only trade the breakout of this BD line. Usually, if you have triangles, so this is a symmetric triangle, yeah, you have the market an uptrend, consolidation pattern, and then the market moves further. Yeah? Usually, the volume and volatility decreases in triangles, so it comes down. And sometimes you have within the triangle a complex wave. Complex wave means that this C wave is divided in several other moves. It's not so. It's not really a problem, but I want just to mention this. Yeah, sometimes this move, the C wave, could be a little bit longer than the other moves. So wave C tends to be more complex. And if it's complex, then it's lasting longer and contains a deeper retracement. So there are, so this is just to show up the different types. So we have this symmetric. Symmetric means both lines come together and it's symmetric. The contracting means that the lows may be on one level. It could be as well the highs, but here the lows, and the move is contracting. Yeah. Expanding means, and that's the only triangle form which looks not really like a triangle, only in that direction, in the left direction, that this moves not converge, that they diverge from both. So B, D, A, C, and the meeting point is here in the past. So, but this is exception. So, how to trade triangles. So that's what I want to teach you now. Usually, you have to keep in mind what is the move before the triangle. It's important. So, before the market builds up this triangle, the market was moving here up. So, I labeled this move A, big A. Yeah? Capital A. So, then the market builds up this triangle, and you see here, that's the AC line. And what a lot of time happens is that there's a wrong breakout with the E. That's why we never trade the breakout of this AC line. And then, sooner or later, the market breaks out here from the BD line, and usually the target for this second move, at least above this top here, but usually if we measure the difference, or the length of wave A from top to bottom here, and add this to the breakout point, that's usually a good target price. Okay? So, same if the market is moving down, triangle, breakout, and again, the length of move A should define the target for C. You see on this slide here that I labeled this breakout with false breakout. Why? The typical thing of a triangle is, after the breakout, you could see a significant move up, and you should trade this move, as well as this move down here. But what happens when this move comes to an end, the market comes back to the apex, to the appendix of this triangle. So, yeah, to this level here. So you see, market moving up, comes back. Moving down, comes back. So there are two possibilities to trade. First, this breakout in that direction, and then the consolidation back to that level. Both possible, and both are strategies I do. Yeah? So, concentrate on this BD line. AC lines are not reliable. They're not reliable. So, that's the S&P. You see that the move's getting smaller, smaller, typical for triangles. And, you know, the market broke this AC line here. And, you know, my advice is, don't trust AC lines. Trust this BD lines. These are good lines, that not. And what happened is that the small triangle widens to a bigger one, and it developed to a bigger AC line. Okay, A, B, C, D, and now the move maybe. So, the only significant signal from triangle trading you could get from this is when the market breaks the BD line. So in the last few days, so you see the presentation I finished in October. Now in November, the market is here. It broke this line, but this line is not a signal for me. Maybe I'm short because of this average true range from here, yeah, from the VIX, but this is not a signal from triangle pattern because that's the AC line, and maybe it's turning to a different pattern. But I know for sure if the market is breaking this BD line, maybe whatever, in the next days when the market comes up, that's a significant signal, uptrend, A, B, C, D, E, and the market breaks out. And I know that this E can overshoot this AC line. So for me now this BD line is very important for trading. Yeah? As long as the market is above, I handle this market like any other markets. So the signals, it's trading, it's down, but as long in the moment we go above BD, it's a long. Yeah? So you have two possibilities to trade. First was a breakout. The second is to buy the false breakout. So if the market is moving here to this E level, A, B, C, D, E, false breakout, and then going up. Okay, wave E can fall short. It must not break through that line. It can stop here. It can stop here. But that's one very aggressive way to buy the market. And I only do that if before that triangle, the market is in clear way up. And all my trading tools say that the market maybe will go up. In the moment, my trading tools not saying that the market will go up. So that's the reason why I'm not buying S&P. Here's some example from expanding triangle and DAX in June. A, B, C, D, and you see here this overshooting E with the Brexit before the market was up, triangle, and then you could see market is going up, breaking BD line, is going higher, and when now above this point, went here. It's still not reached my targets. My targets were higher, but you know that's a real market, and the others are examples. So I don't know. Now is the market again back here to that level, but it's a typical expanding triangle, what you could see, and that was a possibility for buying the E. I will show you some other triangles. That's the Japanese yen. Some really, it looks like cherry-picked examples, but are really, for teaching purpose, are very good. Even for trading, but usually you don't have such good signals. You see here, that's the market moving down in a clear trend. And then it starts the consolidation patterns. So, consolidation pattern means wave A, B, C, D, E. And you have this BD line, and you have this AC line. And typically, here, the E is overshooting AC line. That's normal. This happens all time. Yeah? So, but it's still good, this triangle. So as long as the market, this E wave is not going above the C, it's still good. And you see one opportunity to sell because the market is down. Here was the other opportunity to sell. Then the market pushes down and makes a new consolidation pattern, A, B, C, D, E. In this case, the E wave falls short, so it doesn't manage to touch the AC line. This could happen as well. Usually, if E falls short, it's a stronger signal because it tells you the market could not manage to go up, so maybe the pressure, down pressure, is already too big, and you see here that move down. But what you could learn from all these triangles is, first triangle, breakout, market comes back here to the top of the breakout, here. Second breakout, strong trend down, but now, you remember, Japanese yen is now back on that level, yeah? So in 2016. So this is some long-term charts, but very good examples to explain you what happened. So, Euro, US dollar. We have this trend down, and in the moment, the market is moving in a typical consolidation pattern. Yeah? A, B, C, D, maybe shortfall E. Then we will see lots of pressure in the next few months, as long as the market is not going above here, this line. So that's in the moment on the long term, the triangle pattern in euro US dollars. And you know, I have to check other tools like fundamentals. And fundamentals in the moment says, okay, Draghi still wants to print money. Yellen wants to do on the next Fed session a rate hike. So fundamentally, dollar would be strong, euro would be weak. Fundamentally, the market should come down. These are only odds. It's not a prediction. But from the odds, yeah, market is now pulling back to that line. It's typical as well that if you have a breakout, market comes back to the line and then starts the next drop. So we will see. That's a triangle on the daily US chart. So, and here's some other nice example in the British pound. A few days ago, after this huge drop, we saw this A, B, C, D, E, but the market never managed to break through this BD line. Instead, and that's why I said that a triangle is sometimes very difficult, even if you see that, you don't know if it really breaks through. As long as it's not breaking through, what the market did, in fact, it comes now up, the market is now here, and so it offset the triangle. This could also happen. But it's not a problem for a trader because I told you, watch at this BD line. As long as the market is not going below this BD line, don't do nothing. Within a triangle, so here, trading within this triangle, my best advice is to keep your fingers out. because you have to wait until the triangle develop. Here, the volatility comes down, 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 and it's very, very difficult to make profits within a triangle. As soon as this pattern is resolved and finished, and we get this breakout, usually the move is very fast, very big, and it's easy to make money then with that. But as long as the market is not breaking BD line, stay out. Okay? Very simple thing. So, okay. So, I introduced to you in this session three strategies, 2 based on volatility, and 1 for the consolidation. The triangle patterns are consolidation patterns. Most important that you wait until the consolidation is finished and that you only trade the breakout of the BD line. Yeah? Stay out of triangles as long as they develop. The other triangles you could trade on any time frame, even on a 5-minute charts. The other pattern, the ATR and the VIX, some long-term strategies, but they work very good. Here you sell after the market expanded its own range more than 2 times of the average 2 range. This happens only 2 or 3 times a year, usually. And here you sell when the VIX moves more than 2 times of its standard derivation from its mean. If this happens, that's a sell signal. Both signals are not really good timing signals, so you could not expect that on the next day you're already in profit. Usually, after the signal, there are a few days left to make your decision, to set up your trades, and then a few days later, the market starts to drop. So what you expect usually after the signal is a significant move against the average 2 range down move or up move, but that's a perfect opportunity to go in, and you have a perfect stop point. The perfect stop point is the price. We'll show you here where the move starts. Never trade without any stops, because even if you have a high probability strategies like this strategy is, yeah, it's not for sure. It's just statistics. And like on a dice, where statistically the 6 should show up, it could happen that the 6 will not show up if you roll the dice 6 times. Yeah? And that's the same. So we will stop for another break. And in the next part, after the break, I will tell you, based on my personal experience, some important thoughts. Where we are? So, just one sec. So, how to improve your trading sustainability. Yeah? Okay, thank you.
Thank you. Wow. I think we heard a lot of things from you in these 2 parts. However, there is something that you guys didn't hear. And that was an interview what we made during the break. So in a few days from now on, we will send it out so you can actually watch it. And in that interview, Birger will talk about his horror story, what he had. You know, it's Halloween, so so basically it's going to be pretty good. Now we're going to have a 30-minute break, and then Birger will continue. But in the 3rd part, we will have a lot of things to do. At the end of the seminar, we will actually, and Birger will actually give the prizes to the 3 winners. It will take like 2 minutes or something like that. And after that, well, actually everybody received an email from us like an hour ago or something like that, half an hour ago. In that email, you will find the promotions, what we will talk about at the end of the seminar. And promotions, like total worth is like more than 10 million forint. So, but it's very limited to people. So we will talk about that after that. So now enjoy your 2nd break.
Just because you can trade anywhere, anytime, doesn't mean you should. Sometimes it's better to keep things simple, concentrate, focus. Admiral Markets understand your needs, so you can trade FX, safe in the knowledge that you're getting the best possible service, without special effects. Admiral Markets, because trading foreign exchange is exciting enough.